In Nelson Nash's book, Becoming Your Own Banker, he mentions that your goal should be to have your premium deposits equal to your expenses. Today, we're going to do a breakdown of if you should be paying your expenses through your policy loans. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel, and don't forget to hit that bell to be notified when we upload new videos twice every single week. Specially designed whole life insurance policies designed for cash accumulation are powerful assets. They provide safety, compounding, and a guaranteed death benefit for a named beneficiary. They allow a way to pass on generational wealth primarily through the death benefit, but also offer many living benefits that the policy owner is able to take advantage of during their lifetime. Mainly, they're able to take policy loans, a contractual guarantee in these contracts.
And the utilization of policy loans can make your money, the rest of your money, more efficient.
However, you don't want to overestimate what these policies are capable of achieving, because it could leave you in a position where you're feeling pinched and consequently making poor financial decisions. One of the most misleading concepts that we've seen people advised on is running all of their expenses through their policy, whether it be personal expenses, household expenses, or business expenses. You see, these policies are great for a few things. They're a great warehouse for wealth. They're a great place to store money to build up for investments. And they're a great way to help you get out of debt and get out of debt more quickly and on the positive side instead of at the zero line. However, running your expenses on a monthly basis through this policy is not advisable. Leave us a comment down below. Have you ever run your personal or business expenses through the policy on a monthly basis? In some cases, it may make sense. For example, if you have a job loss and you don't have access to other money, your whole life insurance policy is a great way to have an emergency fund built into your financial plan where you have guaranteed access to that money.
And that's the key. You've set up this policy maybe to be an emergency fund, and an emergency occurred. Now you have access to capital. But to willy-nilly run your expenses through your policy, that is a big no-no.
You see, traditional banks are still good for the convenience of debit. When you hear the term becoming your own banker, it's for major purchases, financing major capital purchases, vacations, paying off debt, investments, larger purchases on a less frequent basis.
But stepping back and looking at this whole concept of running your expenses, whether it's a business expense or personal expenses, through your policy, what you've literally done is you've added the concept of additional interest to your financial equation. And paying interest is never a good thing. And make no mistake, when you borrow against your life insurance policy, you are paying interest not to yourself, to the insurance company.
With the infinite banking concept, it is suggested that you use a dividend-paying, mutually owned whole life insurance company where the policy owner is part owner of the company as it relates to their policy, but you're not directly receiving that interest back.
And it's real simple. If the insurance company makes a profit on your policy, they pay a dividend. Those dividends are credited back to your policy. Why? Because you are the owner of the company as it relates to your policy. And if you're the policy owner, then all of the profits that the company made come back to you.
It may seem like a really good idea to be running your monthly expenses through your life insurance policy. However, it may not be all it's cracked up to be. Check out our latest YouTube video to learn exactly why you should be using these policies and how not to be using these policies. We'll see you there. In conclusion, these policies are great for financing major capital purchases, investments, and paying off debt. However, running your everyday monthly expenses through the policies causes you to pay undue and excess interest. Every dollar you pay unnecessarily towards interest, you're not only going to lose that dollar, you're also going to lose what that dollar could have earned you had it been invested.
It's called opportunity cost.
If you'd like to learn how to make your cash flow more efficient and how to put this process to work for you, your family, or your business, check out our website at tier1capital.com to schedule your free strategy session today. Also, if you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.